Joining us right now is Scott Wren. He is the Wells Fargo Senior Global Equity Strategist. Scott, it's good to see you. Thank you so much for joining us. Can this run continue?
Well, Maria, I tell you, I think, stocks are not cheap right now, and I think they're pretty close to or at really fair value. We're right about where we thought we would be at the end of the year. But as I look out over the next 12 months or so, I think there's still some upside here. Let's say the S&P 500's 5% higher. You tack on a couple of percent for dividends. And so I think it's reasonable to expect over the next year or so that we get about a 7% total return, something like that. That's certainly not the 22% that we saw last year and, what's going to end up being a good number this year. But it's still good. We're later in the cycle, and you can't complain about that.
Hey, Scott, as you're dealing with people, how are you helping them to set expectations? I mean, if we've been on this long run and people are expecting that to continue to go, somewhere reality is going to fall.
Yeah, Chris, here's the thing, and you know this as well as anybody, is retail investors, many of them have been on the sidelines for much, if not most, of this expansion. Unfortunately, they've been paranoid. They've been sitting on a lot of cash, and I've sensed lately, just over the last few months, and you talk to people, and you're out mixing it up socially and things like that, and there's a little bit more interest now, and of course, the bad thing about that is people are most excited at the top. They're nowhere near excited right now, and I think before this thing is all over and done with, you'll see some chasing and some excitement and things like that. But, for us, it's been a real battle to get our clients fully invested. They remember the tech bubble burst. They remember the financial crisis. They're older now, and so, it's an effort. It's an everyday effort to buy the pullbacks when we see them and those kinds of things. But that's what we've been talking to our clients about.
Scott Wren, I'm going to put you on the spot. Paul Manafort, guilty on 8 counts related to a personal financial fraud. Michael Cohen pleads guilty to 8 counts. Why would that matter to the stock market? Would it have any impact on the economy at all?
Well, Dagan, and I'm not a lawyer, but certainly this is going to this is a potential headwind for the president, and it could be a damper on the stock market, which I think is only temporary because, the underlying trends, I mean, we've got good economic growth. We have modest inflation. We have a great labor market. What we need is the global economy to pick up a little bit more. If those things can continue, then I think a lot of these political type of issues can be kind of forgotten, so to speak. But there's a couple of things going on with those two particular, the guilty plea and the Manafort thing, that are going to persist, and it's just another thing for investors to worry about.
Well, let's go back. I mean, when you look at what happened during Clinton and when you had the Whitewater investigation, Dagan, you were mentioning this earlier, we had some upset initially, but things came back in terms of what happened. You have that data, right?
I mentioned this yesterday because I looked this up a while ago. So the S&P 500 from mid-July in 1998, because I'm old and I actually remember this, through the end of August, the Ken Starr report came out in September 11th of 1998. The S&P fell 19.4%.
Because they
almost
were worried
20%.
About impeachment.
Right, but then it recovered all of that decline by nearly the end of November of that year, even while there were impeachment proceedings going on against President Clinton. And people still have fond feelings about President Clinton because the economy was so good, because there was that overall sense of prosperity in this country, the internet boom, incredibly low unemployment, and the backdrop is exactly the same today as it was back in the late 1990s.
Yep.
Scott, you look at the world. One of the things that happened in the 80s with the Reagan reforms is that other countries began to do what we did, even if they wouldn't give us credit. Do you look at Europe or Asia? Are they going to be putting in major tax cuts? I know they've been doing small ones, but the kind we did in December and the kind hopefully we'll do after these November elections, so they start growing again, removing these impediments and barriers instead of just relying on monetary policy?
Yeah, you know, Steve, I tell you, it's been, you know, if you're a fan of Europe, you can't be a fan of the regulatory environment and how slow they have moved to loosen up some of the headwinds in their economy. So, you know, as I look ahead, I think it's still going to be a tough road to hoe in Europe in terms of making the business environment better, in terms of making the changes that they really need to make. You know, China, you know, that's a tough call, too. So what I think you're going to see, and I think, you know, the market, if there's any concerns out there right now, you know, just look at the performance of the EFA or the Emerging Markets Index. You know, there's some fears out there that we're going to see slowing global growth, which I think could be a headwind for our economy. But I just think that what the U.S. has done with the tax cuts, with regulations, with those types of things, that's going to be hard to repeat overseas. And I just really, I'd love to be wrong about this, but I think change, if it comes, it's not coming anytime soon, and they'll have to be drugged kicking and screaming to making those changes.
Well, do you worry about the do you worry about the Fed at all in terms of interest rate rises? We already know about September, so that's going to be a non-event.
Yeah,
but looking ahead, is that going to be a headwind?
Well, I tell you, I think right now, you know, our feeling has been for the last year and a half that if the Fed hiked rates more than 3 times this year, that was going to be a headwind for stocks. I still think that. I think the Fed, I think Jay Powell's done a good job explaining himself. I think right now, with what's built in for this year, which in my opinion is 3 hikes, that's what our fixed income team's looking for. Next year, maybe you get a couple there. So, you know, these cycles typically end with the Fed making a mistake.
Yeah.
I don't think they're going to make a mistake this year. We'll have to see what happens. But, you know, if things heat up and inflation does, in terms of economic growth, and inflation does really heat up, I mean, the Fed's going to move on this, and they're going to change their pace. So, I don't think that's going to happen, but you know, by the end of this, the Fed's probably going to have something to do with turning the economy lower and the next recession starting.
So you said 3 hikes. That means you're expecting September, but not December.
That's correct. I think so, Maria.
You know,
and then, you know, maybe you see a couple next year, something like that.
What's interesting is how things have shifted, because this remarkable run in stocks began, as you know, bottomed out March 9th of 2009, and the most valuable companies were ExxonMobil, Walmart, Procter & Gamble, AT&T. Just one technology company on that list was Microsoft. But nearly 10 years later, look at the shift in terms of the top 5 most valuable companies, all technology focused. Apple, Amazon, Alphabet.
You look at the tear. You look at the tear we've had. I mean, consumer discretionary has been the best performer, followed by technology. I mean, those 2 sectors have crushed the return of the S&P 500. And, you know, they're full of the popular names right now. They won't be after the sector change necessarily, but they have been certainly since the March 2009 low.
All right. So just to be clear, you would put new money to work in stocks today, then?
Yeah, I mean, I think for us, we've been telling our clients to do that. We've had multiple opportunities this year and really over the last 12 months to invest. I mean, we want our clients stepping in on pullbacks. We've told them to have a plan. We want them to lean towards industrials, consumer discretionary, financials, healthcare. We don't want them to hide in utilities and staples. We've been telling them that for 2 years, and we're going to continue to tell them that.
All right, Scott, great to talk with you. Thanks so much. Scott
Have a good day,
Wren
guys.
joining us, Wells Fargo.